Thank you, Mr. Chairman. Chair Yellen, welcome back to the committee. We routinely hear from President Obama and Senator Warren and others that an absence of regulation was the principal cause of the financial crisis. I'd like to explore with you today the threats to financial stability posed by too much regulation. Let me take as an example the CLO market, collateralized loan obligations. This market provides more than $400 billion in financing for hundreds of American companies that employ more than 5 million people. They are a crucial source of funds for many companies that cannot issue bonds. CLOs also performed extraordinarily well during the last 20 years with a negligible default rate. They performed better than high-grade corporate bonds over that same period of time. Unfortunately, we are hearing from market participants that the risk retention rules promulgated by the Fed will cause a contraction in the CLO market and a credit crunch for American companies. Alternative sources of funds are available through hedge funds and the like, but they are not a stable source of funds, and they will certainly demand a much higher interest rate. Do you believe that American businesses are better served with expensive short-term financing from hedge funds as opposed to stable long-term financing options?
Well, we want to make sure that businesses have stable long-term financing sources, but we also want to make sure that when securitizations take place, that the originators do have skin in the game so that we avoid the kinds of problems that happened previously, and that's what those QRM rules are designed to accomplish.
Well, I appreciate it. I would make a distinction between securitized mortgages, which were at the epicenter of the financial crisis, as opposed to highly rated senior secured commercial and industrial loans that never defaulted in 20 years. But I do appreciate the point about skin in the game, and I wanted to just ask you about a letter that we sent to regulators. I joined a bipartisan group of members of Congress who wrote to you recommending that you support the concept of a qualified CLO, much like a qualified mortgage, a structure that would ensure the safety of these vehicles, but also ensure a continuation of financing to hundreds of companies that rely upon them. Is that something that you would be open to?
I think it's something we could have a look at. I'd have to get back to you on it.
I appreciate that. I'd love to have that discussion with you. Let me move on to the issue of illiquidity in the market generally. Secretary Lew has denied that there's a liquidity issue or that some of the post-crisis regulations are contributing to illiquidity in the market. In your previous testimony before this committee, you said that you would not rule out the possibility that regulations are playing a role in decreased fixed income liquidity. Certainly your colleague, Lael Brainerd, acknowledged that regulations may be a factor in diminished fixed income liquidity, and there's been a lot of research on this. I'm quoting from one often cited piece of research. Almost every institutional investor in almost every market seems worried about liquidity. Even if it's here today, they fear it will be gone tomorrow. They say that e-trading is contributing to volume but little depth for those who need to trade in size. The growing frequency of flash crashes and air pockets, often without cause, adds weight to the fears. And the most frequently cited explanation is that increased regulation has driven up the cost of balance sheet and reduced the street's appetite for risk, and hence their ability to act as a warehouser between buyers and sellers. What would lead you to doubt that increased regulation is actually creating a destabilizing impact in terms of liquidity?
Well, it's just there are a bunch of different things going on in these markets, and we're trying to carefully study, and it's, the Treasury market and the corporate bond market aren't the same. The conditions are quite different, and the role of the broker-dealers is different. High-frequency trading has become very prevalent in the Treasury market, and
I hear that explanation. Let me just jump to one other potential theory here, and again, the same piece of research. The more liquidity central banks add, the less there is in markets. In addition to regulation, central banks' distortion of markets has reduced the heterogeneity of the investor base. And so the question is central bank liquidity forcing investors to view fixed income and equities as expensive, making markets more prone to sudden corrections?
Well, we hold significantly more assets, the Federal Reserve and other central banks, than we did prior to the crisis, but we have very deep and liquid markets in the Treasury securities and mortgage-backed securities that we hold. So I'm not aware that our behavior is significantly influencing market functioning. I'm not aware of any evidence suggesting that.
Thank you for your testimony.
Time of the gentleman has expired.